Welcome back to Unlocking the Future. What happens when you combine the stability of traditional finance with the power of blockchain? We're finding out with DigiFT, a regulated exchange for real-world assets, RWAs, that's, building the future of finance right now. But before we dive in, did you know that only 40% of you listening are following across our socials? Come on, guys. If you like the show, hit that follow button and collect our episodes on pods.media. Your support is what keeps the show going. Thanks, mates. Okay, so today we're taking a closer look at DigiFT, a name that's making waves by blending the old and new worlds of finance. Our mission for you today is to extract the most important nuggets about how real-world assets are being revolutionized by blockchain, making you well-informed on this pivotal shift.
Yeah, it's definitely a critical area right now. The RWA tokenization sector, it's seeing some real momentum. It's not just growing, it's really a fundamental rethinking of how assets are owned, traded, maybe even leveraged. We're seeing this shift, from theory to very practical regulated solutions, bridging finance worlds like never before. It kind of sets a new benchmark.
The new benchmark. I like that. And speaking of benchmarks, DigiFT's been in the news. They recently secured a significant US $25 million funding round led by major investors. And here's where it gets really interesting. They've also locked down a crucial license in Hong Kong. That makes them one of the very first platforms regulated in both Singapore and Hong Kong. What does this signal?
Right. That dual license is huge. It's not just bureaucratic paperwork. It's a very strategic move. It fundamentally de-risks the whole thing for institutional players. These approvals show a strong intentional push towards building something globally compliant, something scalable. For big financial institutions, regulatory clarity isn't just nice to have. It's absolutely essential. It gives them that legal certainty, that trust they need before jumping into new tech. So being regulated in two major hubs like Singapore and Hong Kong, that sends a massive signal. It says we're serious, we're legitimate, we're here for the long haul. It builds foundational trust.
Okay, trust is key, absolutely. So let's get into the mechanics. How does this work? How do you take something solid, like, say, a U.S. Treasury bill, and represent its ownership on a blockchain?
Sure. So think of DigiFT as this end-to-end platform. You start with a high-value asset, could be a T-bill, a corporate bond, maybe shares in a money market fund. DigiFT then legally represents the ownership of that asset digitally on a public blockchain. This is done using smart contracts. Think of them like self-executing digital agreements, tamper-proof. Each token created represents a fraction, a slice of that underlying asset. So instead of one big bond certificate, you might hold, say, 100 tokens, each be 1/1100th of the bond. It's all verifiable on-chain. It's like a digital deed, but, programmable and accessible globally.
A digital deed. Okay. But how does that digital token get the same legal weight as the physical thing? Isn't there a perception issue, maybe a risk, that makes traditional folks hesitate?
And that's exactly where the regulation is so crucial. And why DigiFT's approach is quite smart. The whole process, tokenizing it, trading it, it all happens under the regulator's watchful eye. This isn't some unregulated digital free-for-all. These tokens are legally recognized digital representations of ownership. The rules ensure they have the same legal standing, the same security as the old-school paper versions. That's what brings institutions to the table. They're buying a regulated instrument that just uses blockchain for efficiency, not some wild new thing.
Right, got it. So once it's tokenized, legally sound, what then? How does the platform create new trading opportunities, liquidity?
Exactly. Once tokenized, they become tradable on DigiFT's exchange. And this is where you see the real benefits kick in. Fractionalization, first off, like we said, you don't need millions to buy a bond piece anymore. You can buy a smaller, affordable fraction, opens it up. Beyond that, putting them on the blockchain creates new secondary market liquidity.
Yeah.
Instead of waiting days, maybe weeks, for a traditional trade to settle.
Yeah, the T+2 nightmare.
Precisely. Here, trades can settle in minutes. That's speed plus the transparency of the blockchain. It totally changes the game for assets that weren't very liquid before. You're essentially creating this global 2047 market.
So this sounds like a game changer for a couple of reasons. First, accessibility. You mentioned democratizing access. Does that just mean lower minimum investments, or is there something deeper changing for accredited investors?
It's definitely more than just lower minimums, although that's a big part. The really profound shift is opening up access to assets that were just walled off. High entry costs, geographic limits, complex structures kept most people out of things like prime corporate bonds or even T-bills directly. Tokenization lets accredited investors buy fractions, often from anywhere, much more easily. It levels the playing field a bit, makes sophisticated investments more available, reduces cross-border friction, it changes changes who can participate.
Redefining participation. Okay. And the second big piece is efficiency. How exactly does blockchain trading cut out the middleman and speed things up so dramatically compared to the old ways? What's the real impact?
Well, the impact is huge. Traditional finance has this whole web of intermediaries, right? Brokers, custodians, clearinghouses. Each step adds cost, adds time, adds potential errors. Blockchain, especially on a platform like DigiFT, streamlines all that, cuts out a lot of those steps. So costs drop significantly. But the settlement time, that's the kicker. We talked about days or weeks settling a bond. On-chain, minutes.
Minutes.
Literally minutes. Think about the capital efficiency that unlocks. Reduced counterparty risk.
Yeah.
Treasury management becomes way more agile. It's moving from slow, step-by-step processes to near-instant, all-at-once transactions.
Minutes for settlement. It still sounds almost futuristic compared to waiting days.
Yeah.
But, okay, speed and efficiency are great, but for institutions, it always comes back to trust. How does being regulated specifically tackle those deep-seated worries about security, legal standing, all that stuff traditional finance absolutely needs?
You nailed it. Trust is everything. And being regulated is the answer. When DigiFT operates under licenses from places like MAS in Singapore and the SFC in Hong Kong, it means they're following strict rules. KYC, AML, know your customer, anti-money laundering investor protection, cybersecurity standards. It's all baked in. It's not just tech security, it's legal certainty. Institutions know they're in a familiar legal playground, not some regulatory Wild West. That's non-negotiable for them. It's the bridge that makes blockchain adoption feasible for the mainstream.
So given these advantages, accessibility, efficiency, trust, who's actually signing up, is it still mainly crypto folks, or are the big traditional names jumping in?
It's actually a really interesting mix, which shows the broad appeal. On one side, yes, absolutely, the traditional finance giants are getting involved. We're seeing names like Invesco, UBS Asset Management, Wellington Management, global players. They're partnering with DigiFT, exploring tokenizing their funds, managing assets on-chain. This isn't just dipping a toe in. It's serious exploration of new efficiencies in distribution. Their involvement speaks volumes.
Wow. Okay, so serious players. What about the other side? The Web3 native companies, the crypto funds. What's in it for them?
That's the other key user group. For them, DigiFT offers something vital: stability and diversification. Think about it. Many crypto funds or Web3 treasuries hold a lot of volatile digital assets. Using DigiFT, they can convert some of that into stable, real-world assets like tokenized T-bills or money market funds while staying on-chain. So they can earn yield, reduce their overall portfolio risk without having to completely bridge back to the traditional banking system. It's about de-risking within the ecosystem.
Interesting. And outside these big players, what about, say, developers? Is there room for innovation on top of this?
Oh, absolutely. The potential there is enormous, and honestly, we're just scratching the surface. You've got these secure, regulated, tokenized, real-world assets now available as digital building blocks. Developers can create completely new apps and products. Imagine embedding tokenized treasuries into DeFi lending protocols as top-tier collateral.
Right, stable collateral.
Exactly. Or building automated investment tools that use real-time data from these tokenized assets. It opens up a huge design space for new financial services that blend the best of both worlds.
Now, it all sounds incredibly promising, but the path forward surely isn't perfectly clear. You mentioned legal fragmentation earlier. DigiFT's got Singapore and Hong Kong covered, which is great, but globally, it's still a bit of a patchwork, right? How does that hinder things?
Yeah, that patchwork is a very real hurdle. Having those two key licenses is foundational, but scaling truly globally means dealing with dozens of different legal systems. Every country might view digital asset ownership slightly differently. Different securities laws, different rules for investor protection. It makes cross-border trading and settlement complex. You need serious legal legwork to ensure a token recognized in Singapore is also valid and tradable, say, in Europe or the US, under their rules. It requires a lot of effort towards harmonizing standards. It definitely slows down global expansion and adds operational complexity. True global interoperability is still a ways off.
Okay, legal complexity. Daunting. What about other barriers? Technical ones, maybe? Or just getting people to understand this?
Well, technically, interoperability between different blockchains is a big one. Moving these tokenized assets seamlessly and securely between, say, Ethereum and another chain, or even between different platforms. It's not trivial. Requires sophisticated tech solutions. And then there's the education piece. It's huge. You're talking to two different worlds. For traditional finance folks, you need to convince them this isn't just crypto hype, that it's secure, regulated, and actually better than their old systems. For the crypto crowd, you need to build trust in regulated platforms and the value of linking back to, well, boring real-world assets. It takes time, demonstration, building confidence on both sides.
Makes sense. Despite those challenges, DigiFT seems ready to push forward, especially with that new funding. What's next on their list? How are they planning to expand?
They've got some clear plans. First is diversifying what they offer. Right now, it's strong in fixed income, like treasuries and bonds, but they're looking to add other fund types, equities, maybe even alternative investments down the line to broaden the menu. Second, enhancing the utility of these assets on-chain, developing more ways RWAs can plug into DeFi. We mentioned collateral for lending, that's a big one, making these assets actively useful within the digital ecosystem. And third, obviously expanding their geographic reach, seeking more regulatory licenses in other key financial centers, building on that Singapore-Hong Kong foundation. Connecting this back to the big picture, what DigiFT and others in this space are doing, it feels like more than just a tech upgrade. It's really shaping up to be a blueprint for how finance could work in the future. By prioritizing regulation and focusing on real, tangible assets, they're showing how blockchain can create a financial system that's genuinely more open, more efficient, and just better connected for everyone. Institutions, investors, everyone. It's that bridge.
So what does this all mean for you listening? As this landscape changes so fast, how might tokenized real-world assets affect your own thinking about investments? Or maybe what traditional assets do you think are ripe for being tokenized next? Definitely something to think about as you continue your own deep dive into the future of finance. And that wraps up our deep dive on DigiFT and the rise of tokenized RWAs. Thanks so much for joining us. Remember to follow us on socials and pods.media. Don't miss the next one. We really appreciate the support.